Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 29th, 2019. I want to do a video overview of the aerospace and defense sector. Now, I'm not going to go through all the components. There are quite a few. We have BA as an active trade idea. I'm going to get to that one. Probably spend more time on that than anything else, since that's the largest. You have this ETF as well. ITA, which if you want full exposure to the sector, one shot fits all, or covers all, I should say. You buy ETA or go long or short, you have all those stocks in the sector. So there's one option there. But let's look at the charts of the individual components. Just a quick recap on BA. This trade is entered and based more so on the weekly charts, the long-term charts, than on the daily. But what happened on the daily? We had this divergent high, steep bearish rising wedge, breakdown, and then we had this pennant formation pattern that started to break down, but then that so far BA has popped back up. And again, it's not going anywhere. It's up from where we shorted, but it's still below the stop right now. And a lot like the broad market, it's just in this recent sideways trading range. These aerospace and defense are industrial companies, and they're some of the largest industrials that we have in the market. They definitely have a big weighting on the S&P 500 and the Dow. So I don't want to spend too much time on the daily charts, because the point of this is really look at the sector from a long-term approach for three reasons. Trade ideas, number one. I'm only going to go over the top handful, half dozen or so largest components, because that will determine where the sector goes. I'll show you the charts, some developments to watch right now, and also, of course, for the sector itself, if you wanted to trade ITA. And then ultimately, this will also affect where these stocks go. Will most likely affect or coincide, I should say, where the stock market goes, because they're industrial, so therefore they're cyclical companies, meaning when the economy is strong and booming, they do well, and when it's not, and it's in a recession or a bear market, they do poorly. So let's jump over to the long-term charts, and before I do, I just want to make mention on this trade. Here's a big old gap right here, this gap, and we're coming up to the top of the gap. So I set the stop, might be a little aggressive. It's right up at that bottom of the gap. Again, up to you if you want to play the long game on this one, meaning trade it based on the long-term charts. If that level goes and they take out with conviction the top of the gap there, next resistance up here is about 399.29 or so. We'll call it 400. There's a huge, very technically significant gap there, as well as another gap on the other side of it. Big level right there. So like all trades, and you guys know me, if the charts still tell me to be long or short or go back in, I will re-enter a trade that was stopped out if and when the next objective entry comes. So this one, we're watching a lot of things. I'm watching it come off oversold levels. Nothing falls forever. PPO crossing up. But let's get to the good stuff, and we're going to start out with the longest term charts. Usually I cover. I don't really pay much attention to yearly or quarterly charts. At times I'll look at those, but let's just start here with a monthly chart. This is good enough. Goes back to the mid 80s. Imagine half the people listening to my voice now weren't even born back then, so this is a very long-term chart, and it speaks pretty clearly to me. When I look at this chart, it's not very hard to annotate and to mark up. We've been in a secular bull market, particularly in this BA over that time. This is a large secular bull market, and within the secular bull market, we've had cyclical bear markets and cyclical bull markets within it. So let me try to color a line tool here down below off screen. Here it is. So these are these trend lines. They show you the uptrends. And I could do every one. You can see they're already marked. And in most cases, and back here we had it, it goes to the left of the chart, we had a wedge, a divergent high. So what you can see below, these are the drops from the peaks each time. Almost all those peaks, in fact every peak but this one right here, came with negative divergence, and that's what I want to point out here. And those divergent highs, they are powerful things. The problem is this is a monthly chart. They can take months and even sometimes years to play out, and so you can have divergences building for years. But I'll talk a little bit more on the divergences, and I want to say this. Technically speaking, I cannot say these are immutable forces, technical forces. Close to it, but immutable means cannot be changed. Divergences can be changed, they can be taken out, but I can tell you, and again, we're going back here decades, and you can see there's a lot here on the chart. The relative frequency periods between these are, again, bull and bear markets, and I've done the math for you. Took every, from the peak to the bottom, 56%, 48%, 52, 65, 73, 36. So you get the idea that typically Boeing gets cut in half from the highs every time we've had these weekly divergent highs, and there haven't been that many, spanning several decades here. We can see the last time we had negative divergence on the monthly time frame was back here in it peaked. The stock peaked in early 2015 and was followed by the most mild correction that it's ever had. Again off the divergent high in decades. And that was still a 36% drop. So what happens now? Let's look at what's happening now. Although technically we had some divergence forming at this recent high here, that wasn't the kind of divergence I look for. I look for the PPO to cross over and then come back and put in another high, or at least come close. In this case, when we really zoom in tight, we never made the bearish cross, and that's fine. Sometimes you just back test and kiss the lines. You can see here. So there was our first crossover. Again, so what that does is on divergence, there's really two parts. Sometimes you get these flattish looking lines, but you need that first reaction high and then the PPO line. In this case, it came back, made a near kiss to that second high right there. And you can see the two successive highs, a lower high again in the RSI, and that's what makes divergence. So prices making higher highs with the indicators making equal or lower highs. So that's it. You play the odds. If whether you're a betting person or not, you go to Vegas, you play the ponies, bet the odds. The odds say that from this point in time, you're probably going to see a double-digit drop in Boeing over the next year or two, and it's probably on average. It tells you they measure about in the mid double-digit percentages, around 50%. If you take the average, take that 73 and average it in with a 36, and you're going to come right here to what that stock's done, possibly more. The excesses in this market are only rivaled by those leading up to the top in 2000, the bubble back then. And here it is. So that one led to that 65 from, I just said we had a near bottom there, and then we came in. The bear market wasn't over until Boeing bottomed out here at 65%. So my money would be on a drop, and I'll tell you right now where I think this one will be within the next 2 years or so. Remember, stocks fall a lot faster than they climb. That's it. So I'll tell you right now, straight up, there's my target, minimum bear market target, I should say, be about 153, give or take, and that's about a 65% drop. And I wouldn't be surprised at all. In fact, I'd lean towards a move down to this support zone. I have these double lines here, and that's about a 73% drop. I have no doubt that a lot of people listen to my voice think I'm crazy, that Boeing can drop 73%, but this is what I do, and this is what the charts do. This is history. You study these things, they happen, and there's reasons. I could sit here and talk all day long, and the fundamental reasons as to why there are, the economy, the stock market, companies, business models, and earnings are cyclical. It's just the nature of the beast. So we're at a period, and there's a trend line I should have added. We're at a period of excesses created by the Fed. So again, I think a 65 to 73% drop over the next few years in Boeing, I would put very, very high odds. Now the thing is, if you're trading it, you have to use stops, and we'll have to, like I said, if they get us out of this trade this time around and the market runs up the new high or Boeing does something, I'll keep it on my radar and look to re-enter that. So there it is. You make your own conclusions out of that, but this chart again speaks clearly to me. We look at the weekly chart, which this trade was largely based off of, and we have several things that stand out to me. Again, this was covered in recent weeks. We had this divergent high here, negative divergence at this point right there. We had a divergent high and a 23% drop. That drop took us down to this primary uptrend line right here. It also started this forming this megaphone, aka broadening wedge pattern right here, We pushed back up to the top of the broadening wedge pattern. Somebody asked me my thoughts when we were just before we peaked out on there, which I shared. I said we were going to have another divergent high. At the time, we didn't have any sell signals. It was right before the second crash. But a week or two later, we peaked. We got a red candle, bearish engulfing candle on the weekly. Boom, boom, boom. A lot of check marks from a bearish technical perspective. The divergences too. Now there's a little work to be done. You can see right here the PPO is sort of flattening out. I want to see that PPO crossover. We need to see Boeing reverse soon. Whether they pop the stop or not, that's irrelevant. If it reverses soon, they pop the stop, and then we reverse, we get a bearish crossover. That will have given me what I call confirmed divergence, and that means this high right here will be a lower high, because if we bounce here, the lines keep coming up, we might make a, we could continue to go up and make a higher high and eventually take this out. So right now, again, just in my book, this is what I call potential divergence. Will be confirmed on any more downside, and that will have to happen soon. Or maybe it happens a few weeks from now. We can bounce off the lines. Sometimes you can see they bounce or they briefly cross, but that's the pattern. And then this is a larger sell signal, by the way, because this is a large bearish rising wedge pattern. So long term, again, this would kind of play into that monthly chart in the scenarios I showed you there. What you'd want to watch for is a break below this rising wedge. Whether it comes later on, it could come later in the year, it could come next year, for all I know. We could work our way up. This is a rising wedge, and prices can work up within the wedge, or they could break down at any time. And then the other thing too would be a downside break of this broadening wedge pattern, the bottom part. But I can tell you this, looking at that trend line should do the trick, because if we break that, then we're probably going to come in, make a run at those lows back from December. But either way, that's a line to keep an eye on there. So there's the long-term outlook for Boeing. I covered that gap to watch on the daily, and again, that stop is right around the gap. If you're in this for the long haul and you say, you know what, Randy, I think this stock also has a downside of 60-70% in the coming years, so I'm willing to give it 10, 12, 15, maybe even 20% on my stop. And you might say, wow, a 20% stop loss. It's all relative. If you're shooting for a 70% profit target, you're doing better than a 3-to-1 risk-reward ratio. That's very favorable on a trade. And the key is, do you want to put, if you've got whatever your number is on your portfolio, let's say it's $100,000. Do you want to put 50,000 of Boeing short? Absolutely not. That's not how you trade. You put a decent position, whether it's 5, 10,000, 15. It's up to your number. But if you're going to give a wider stop, then use a smaller position size, and it all balances out. So let's say you might normally go with a $20,000 short position on Boeing, but you want to go for the swing for the fences on this one. Take it down to 10,000. That will allow you to do a 20% stop loss. Just for an example here. And therefore, if you're stopped out, you would only lose as much in dollar terms as you would normally on a trade of $20,000 that you allowed for a 10% stop loss. So it's all about the dollar numbers you make or lose, not your percentage gains. So when you have wider profit targets, you can allow for wider stops, and the way to adjust for it is take your position size down, because it plays out as well. Your gain is also above average. So it's all, again, it's all relative. All right, so let's go to look at the rest now, the big companies here. Let's go back to the monthly charts. Let's click on this. We'll pull up the sector watch list. Here's all the components. I will sort them by market cap so you can see what I'm talking about. Boeing's 800-pound gorilla in the room here at about 212, almost $213 billion in market cap. It dwarfs the next largest aerospace and defense company, which is United Technologies. And then we go down the line here: Lockheed Martin, Raytheon, General Dynamics, Northrop Grumman, and you can see their market cap there starts to go down. So whatever Northrop Grumman does, it's only a less than a quarter of the size of the market cap of Boeing, but it's still a $45 billion, almost $46 billion company. So we'll just look at a few of these here. All right, let me park this off to the side here. Float in a new window, get it off on that side of that monitor here, and go through these. Okay, so United Technologies, this is a monthly chart. We're going back again to the mid 80s here. Wash, rinse, repeat stuff. This is not market timing or trade entry type stuff when you're going off a monthly chart, but it does help you formulate the bigger picture. And maybe if you're long, say, okay, maybe the end of the run here, I've been long UTX for years, maybe it's time to tighten up stops. So what do we have here going back to the 80s? We have a nice clean up trend line, negative divergence. You can see all the divergence lines marked, bullish, bearish rising wedge, big drop. There was the Black Monday, the crash 87, but it's not like the crash 87 came out of the blue. You can see it here. The same things that I'm using in this day and age. I was just a teenager back then, but you can see the negative divergence. I would have had this on my radar for a short, trading up. There was a well-defined trend line, bearish rising wedge. The same patterns that worked back then, they work today. And you can see, so Black Monday, or at least in the crash or drop back in UTX back then, wasn't random and out of the blue. It was priced into the technicals. It just needed a catalyst, and that's what the market gave it. So there it is, next bearish rising wedge. And they might not look like much, those drops back then, but that was 36-40% drop. That one was much more than that. That probably dropped 60% or more right there. Divergent high back here in 2000. There's the dot-com bubble. Remember, it popped in 2000, early 2001. 54% drop off the divergent high. So again, wash, rinse, repeat stuff. Look for these divergent highs. Like I said, they're not immutable forces, but they're darn close. They tell you when you see divergences building and they're clean, especially clean. What do I mean by that? Separation between the lines right here. They're like two distinct peaks. The larger the divergence, typically the larger the correction. 55% drop. We had extreme. We didn't have divergence on the RSI, but you had an extreme overbought reading, negative divergence on the PPO, and that ended up with a 55% bear market, 54% bear market. Why anybody would expect anything less than that right now is beyond me. There's your uptrend line, very well defined, comes off the bear market low back there. So here's your bull market uptrend line, nice clean bearish rising wedge, breakdown and a back test. So right now, the market's holding up, so these stocks aren't going down. They, like everything else, just about everything rallied off the December lows. So this is a breakdown and a back test. It's a monthly chart. No matter what happens by the end of this video, it's almost 3 p.m. on Friday. The month closes today, and these candles are this candle is too close. So for all intents and purposes, this is a back test of the trend line. We're still on it. It's not clearly regained the trend line. It would not do that until we have a monthly close that is well above that trend line. So there's a back test. Maybe we back test for a few more months. Maybe they take this trend line out. But like I said, in this chart, if you're a betting person and you said I had to be long or short UTX for the next year or two, my money would be on a short. But we'll have to hone in, and I'll look at here. We'll take a look down at the weekly charts. Here's what we see on the weeklies. I don't have the divergence lines drawn. You guys can just kind of fill them in mentally, or replicate this on your chart. You can see most of these had. Here's the most recent divergent high. Let's not spend time on all the others. But nice clean trend line break. See, this is a tradable stock. Some stocks do better than others. You guys know, if if you're a gold member, you're in the trading room, a lot of times you'll ask me, hey Randy, what do you think of XYZ stock? I look at the chart and I say, I don't have an opinion, because there's just noise. There's not clear support or well-defined support resistance levels. There's not a clear uptrend or downtrend line to recognize. Some stocks are like that. So when I'm looking for setups, I'll go through hundreds of stocks, and only a handful, a dozen or two, will pop out as something that I see. And in this case, I see a nice clean uptrend line on the weekly. I see clear negative divergence. Uptrends are great. You can, if you're bullish and long, you keep buying pullbacks to an uptrend, and it works until it doesn't work. And when it doesn't work, it means the uptrend's broken. And if that comes after a divergent high, the probability of a sharp drop, which is exactly what we have here, are very high. And that's the kind of stuff we're looking for here. So now here's the $1 million question on this and the stock market as a whole. Is that it? Is that enough? We had a sharp drop to satisfy the divergence. Certainly is in percentage terms. It is a little unusual to see a complete V-bottom without another check of that low. You can go back in time, look at most corrections. After the big leg down, you came back and you tested the lows again. That's the norm. It doesn't have to happen. You can continue on up after a drop like that. I think it happened back in 1987 with a lot of stuff, so it is possible. Let's look at a few more here. LMT, Lockheed Martin. We're on a weekly, so I'll stick with the weekly chart. And there was really just a big long. That's if anything, that would be our divergence line there. But more importantly, here's a pretty well-defined uptrend line off the early 2015 lows, and you can see a breakdown and a back test here. Let's draw it out for you. Breakdown, back test, and a move down, and still well off the highs. And that's the other thing. A lot of these stocks are still well off the highs. So, the big question is, are we in an early stage of a new bear market in these stocks, or was this just a correction in an ongoing bull market? Only time will tell for sure. But doing these charts so you guys can make your own, opinions on these. What do I see on the week? This is a monthly. I just jumped back out to the monthly. Looks like Lockheed Martin must have only gone public back in the mid-90s, because I don't have any history before that. Still plenty of time, so we're looking at a couple decades here anyways. And at that time you can see this is rolling off the edge there, so we had some divergence coming into that high. We fell from top highs to low about roughly 70%, 71%. We had a nice clean trend line here. We didn't have divergence, but you don't always have to have that. We had extreme overbought conditions on the monthly, or at least overbought. Bearish PPO crossover. These are things you look for as well, especially with clean separation between the lines like that. And from highs to low there, that bear market drop was 43%. This one I'm sure was 50% or more. You can look at it. What do we have here? We had a nice clean uptrend line with a divergent high, that wedge type pattern, negative divergence, boom. What do we have here? A much larger wedge with larger divergence, PPO pointing down. You can see I have a trend indicator I often use on monthly charts on the stock market. It works well on a lot of stocks. Remember, these are industrials, so they're going to be, they're usually most of these are Dow components, or some of these, and they'll trade with it. So this works well on the SPY or the Dow. This rate of change 12, it shows you the trend indicator, the bear markets. And again, we go back to the mid-90s. You can count them. 1, 2, 3 bear markets so far, well, in the fourth, and they were all identified with very few exceptions or whipsaw signals by that ROC 12 flipping to red. And it's solidly red right now, and we're still well below the trend line right there. So is there more to come or not? No, again, only time will tell, but this is not a bullish looking chart. This appears to be just a kickback rally, a bear market rally, like a lot of other things out there right now. RTN, Raytheon, a monthly chart. There's your uptrend line. Again, I'm not going to draw all the divergence. I don't have all these charts marked up. No need. Same story. Most of them you can see the uptrends. And there's our uptrend line. Most recently, breakdown. And one more thing we should look at here on Boeing. I forgot to mention on all of these stocks. I didn't mention it, but you can see it on my chart. I like this 20-month EMA. So on a monthly chart, it's a 20-period EMA, and it does a good job, not during whippy markets, but even then sometimes. Look at the back test right here. Let me get an arrow tool. Oh no, we'll use this line tool. Just look how well during uptrends it acts as support, and during downtrends, once you have a downtrend, it acts as resistance. So we kicked back to the 20 there, kicked back, finally took it out, and then once resistance is taken out, it becomes support. That tells you bull market, uptrend. Break right there. We make a solid impulsive break above the 20-month EMA, and then it acted as resistance all until here. So there was your bear market. Took it out, new bull market, and you can see it acted as support. Little whipsaw here. Nothing's perfect, but other than that, here's your uptrend. A little whippy here. Again, not perfect, but that's a level we're watching right now. We're still above that, and so if you're watching this video and you flag it, I don't do follow up on BA 6 months from now, you want to watch that level. And if you're, see a big red candle through that line, that would be additional evidence that it's most likely in a new bear market. And again, we can look at the other ones as well. You can see here's Lockheed Martin has already taken that level out. It's done a good job right here. The last bull market, 2007 highs. Good. Boom. We broke not only the trend line, it's not random coincidence, we smashed through both the uptrend line as well as the 20-month EMA in one fell swoop. That's a monthly candle, of course. It took a month to finalize that candle, and there's where we closed the month. And that was it. That said, okay, you are in a bear market. You've taken out trendline resistance. You've taken out the 20-month EMA. At that point, you had a couple opportunities to short kickbacks to that level. Again, a little whippy there, but once it was taken, and look how many candles, 1, 2, 3, 4, 5, 6 above it, and that means, okay, we pretty much took it out at that point. These were whipsaws. Came back, back tested it. Successful back test as well. Okay, back test, back test, back test, back test. That told you at that point, buy pullbacks to the 20-month. And as long as it stays above it and this trend line here, you're in a bull market. There's your opportunity. You bought a back test to the 20-month there. You did good for a nice swing trade bounce. However, this was a red flag here. That's a red candle. That means we closed right here at the bottom of it, well below that. Next month, we kicked back. Here, maybe you can't see it on the video. There was our breakdown. The following month, so one monthly close below, second monthly close below, because the body, remember, don't pay attention to these skinny parts. You want to look at the fat part. If it's a green candle, you closed at the top of the body. If it's a red candle, you closed at the bottom of the body. Red candle, we closed down here. That said, bear market, bear market, bear market, bear market. Got above it, but now here's where we are. Here's where we are right now this month, and that was not clearly above it. And you're going to have these whipsaws like you had here, where you move slightly through. And so for all intents and purposes, this is really a back test, or a test of, a back test of that 20-month below. It's not been clearly put in the rearview mirror. If it is, then we might be able to say, okay, this was a correction or a bear market that's now over. All right, so that's lucky. We already did Raytheon, which also, there's that 20-month kicking back. Also look poised to close on it as I do this video on the last day of March. So this monthly candle will finalize in an hour from now, and we're going to close the month on a back test of that, following the breakdown and back test of the primary uptrend line as well. GD, General Dynamics, let's try to get we're on this monthly. You have trend line here, trend line there. There's your break of a trend line, bear market. There's your look down below, you can see the ROC12 solidly saying, bear market, at least by this trend indicator, bearish trend. What else stands out on this chart? Well, you had the recent big, powerful divergent high, negative divergence. I guess I didn't finish marking that up. Right here's your divergence line. This is what I call your a secondary uptrend line right here. That one comes off the 2013 lows, with this being a potential more significant trend line. It doesn't have a lot of reactions, but I figured I'd add it here because we have a reaction there, couple there, and just most recently. 20-month, another way I use this 20-month, by the way, on both the broad markets as well as these stocks, is the slope of the 20-month. In other words, the slope of a line, this is no slope, a flat line. That's a positive slope if a line is heading up, and that's a negative slope if a line is heading down. And so when the 20-month rolls over, as it did right here, so three things happened at this point back in 2000, early 08, after the market peaked. General Dynamics broke below trend line support, number one, sell signal one. It broke, that red candle also took it down below the 20-month EMA, sell signal number two, and you can see the 20-month rolled over from a positive slope to a negative slope. And that's what's happened here recently too. We're down below that 20-month, it's pointing lower, we're well below the uptrend line. This trend line was better defined than this one, but we'll watch this one because we've had a couple reactions on it. So that's that. And then the weekly chart on General Dynamics, same old. Divergent high back here in 2015, 21% drop. That took us down to this trend line here. I guess that's that same trend line I just showed you on the monthly. There's a wedge right there. What did I have that arrow there for? These are old notes. So at that point, we must have had a 20% drop. Where would that have been? To about right here, yeah. So I must have said at that point right here, 20% drop so far, with likely more downside likely to come after the next counter trend rally. So back then, I must have been expecting a counter trend rally. Put that there. That's what we got, and then yes, more downside. So from the highs from that point, and again that note, let's see, I would have updated that back on Oh, I just moved it, so it got updated today. Never mind. That was a drop so far of 37%. And again, from the look of this chart, I don't see, this is a weekly chart, I don't see a lot in ways of making a case for a good reversal here. There is some support there. Where these stocks go will almost certainly depend on where the broad market goes from here. So, but as of now, 200-day or 40-week moving average is pointing lower. This one's in a downtrend. It's hard to argue that. All right, anything on the daily chart? No, I don't have anything marked up there. I didn't go through all these charts before I did this video. Last one, we'll wrap it up here. NOC, Northrop Grumman, excuse me. I haven't updated this chart. Yeah, still same trend line. I like that trend line, nice and clean. Lots of reactions on it. Breakdown and stair-stepping lower. Here's a stock in a downtrend. By every metric I see on the chart, I don't see any divergence down here. We had an oversold reading, but that's played out. Certainly worked off those oversold conditions. We bounced back to that midpoint there. That's usually where, that's just a little tip as well. I like on the RSI, if you put a line in the center point around the 50 level, that does a good job of defining trends as well on a lot of stocks. So if you can see that line right here, we were in, darn, tried to grab this other tool. Here we go. We were in an uptrend, and you can buy back pullbacks to the 50 midpoint level on the RSI, just as you can go long on pullbacks to the trend line. That works until it stops working. It stopped working right here. At that point, we flip to a bearish trend, and what works are everything in reverse. You short bounce backs to the uptrend line, and as well as kickbacks to around that 50 level. It's gone a little higher each time. This PPO is solidly in bear market territory. By that I mean the white line, the signal line, is well below the zero line. It told you from this point to this point you were in a bull market. Right here was in bearish trend correction mode, and even beyond that it was all bullish over there beyond that point in time. So right now it's saying bear market, make no mistake about it. Hey, maybe it's over, maybe not. We won't know for sure until this crosses over. Those are the things you want to look for as a bull if you're looking for more upside in these stocks. You want to see that trend line taken out, a weekly close, an impulsive break above it. You want to see the PPO cross back above the zero line there. You want to see that RSI get well above the zero line or the 50 level, and that's it. And we'll conclude it here with the monthly chart of NOC. That's same story. Again, I probably should have spent a little more time. I just wanted to get this video out before the end of the day. So here's what I see: another divergence. So we had divergence here, we had a correction, we had bigger divergence right here. I just added down on the indicators below. Here, let me get this down here. Okay, start from the bottom. Let's do that. Here it is. ROC 12, solidly in bear market territory. You can see the red lines when it crosses down below zero. Moving up, we have negative divergence here, or we had a divergent high right here at the high. We had a very clean uptrend line that I already showed you that broke. It's moving lower. We're down below the 20-month EMA. We had divergence here. We had divergence here as well. Again, those lines weren't on my chart. I'll add those. There you go. That was our last drop there, and that's it. So target where this one's headed, I could tell just looking at the monthly chart, and I'd want to sharpen my pencil and narrow down the targets on a daily and maybe a weekly chart. But I think at least a kiss of this uptrend line at the very least. If that uptrend line breaks after that, that would be pretty bearish, and that might mean we are possibly entering a new secular bear market, or at least a bigger bear market than we've had in recent years. These were the last bear markets in NOC right here. And again, when I look at the scale of things, this one looks like it's only just begun. Not to sound like the Carpenters there. I think that's a song from the Carpenters. But either way, it looks like early stage bear market action. And based on what I'm seeing, I can't really make a case to step in here, for a long-term swing trade or an investment. Let the charts play out. Let them firm up. Maybe this one's going to new highs. And if it is, and I can make a case to jump in long later, we'll do so. The other thing before I wrap the video up, I love bear markets because the bear market rallies are so profitable and lucrative to trade on the long side. They tend to move up faster. They're big swings, and that'll be the case with a lot of these. If we enter a bear market, we'll look for these moves, these counter trend rallies that you're usually, well into the double digits. There was a 41% rally just 3 months right there. These 3 green candles doesn't look like much, and of course that was just a bear market rally. The next one after that was about a 30% bear market rally. The one off the December lows so far was a 30% bear market rally. So money to be made on both sides if you are not a short side trader. That's what I wanted to end this with. All right, this has been Randy Finney with Right Side of the Chart. Hope you guys have a great weekend.